and welcome to this video module on basic financial modeling, part 3 of 3. In this module, we're going to focus on steps 6 through 10, completing our basic financial model. In the previous model, we did steps 1 through 5, some basic income statement, balance sheet, and cash flow projections, along with linking a few items between two statements, the PP&E between the cash flow and balance sheet, and the depreciation between the balance sheet and the income statement. We're going to spend much of our time in this module on the debt and interest schedule. Let's move over to Excel. If you recall, we finished our last module with a forecast for PP&E and depreciation. Let's move over to the debt schedule, which I've set up for our use. Easiest thing for us to do while focusing on the green cells is to add in the assumed interest rates, which are tied to the assumptions page. Line of credit interest, which we'll lock in, and senior debt interest of 10%, which we will also lock in and copy across. We also need some beginning balances. You could see that in future years, the beginning balance is simply the ending amount of the prior year. If you follow those formulas through, beginning balance is just the previous year's ending amount. For the first year, we need to tie it to the prior year's ending balance sheet, which in this case would be a historical balance sheet. So the historical balance sheet's senior debt was 0. Let's put in the formula for new borrowings. And we're going to tell our model, using one of the conditional statements from Excel, that if the year that we're projecting is equal to the assumed start year of our debt, we're going to borrow the debt balance. If not, 0. And we should see 100 million there. And we'll copy that across. And just to show you that formula in action, if we change that to year 2, we should see 0, and then 100 million in year 2, and then 0. That's how you do some new borrowing. Trickier part is the amortization of that borrowing, basically the years over which it's paid off. So we need a few conditional statements in one formula known as nested conditionals or nested ifs. So first we need to say if there's no amortization period, it's not to be paid off, is equal to 0, then we pay off nothing. If not, well, what else might happen? Suppose we have no beginning amount and no new amount, basically no balance. We need to think of that case and say if those two are equal to 0, then give us a 0 balance. If not, meaning, all right, assume we do have a debt balance. We want to make sure that we're not overpaying the loan. So we can't just say take the loan amount, 100 million divided by 5, because that would be 20 million of payments forever. We want to make sure that we never make a payment when we've already paid off the loan. So we need to look at the previous year's balance. So basically saying if previous year's balance is greater than 0, we want to pay off the minimum of either our normal payment, which would be 100 million divided by 5, the minimum of that, or whatever the previous balance happened to be. So we have no previous balance and amortization isn't kicking in yet. And we're going to copy this formula across, but it won't be working yet because we haven't put everything into the balance sheet. For now, we're going to skip the senior debt sweep. That'll be an advanced modeling topic. And we're also going to leave the line of credit sweep blank at this point, which we're going to link to cash flow in step 9. What we can do is make use of our interest rate formulas, which we can see is the average balance, the beginning and ending amount, times the interest rate. So we've now got some calculations. They may not be valid because we haven't put everything in yet, but we can now tie an interest amount, as we're supposed to do in step 7 of our process, to the income statement. So we now have senior debt interest, which we can copy across. We have line of credit interest, which we can copy across. And we're going to leave the cash interest earned on cash blank for now because we don't have a cash balance to average out on our balance sheet. So we've now completed step 7. Moving on to step 8, which is the balance sheet for the debt levels. We now know that we can link our ending balances to the debt schedule. So we have ending amounts, and again, these aren't all working just yet, but we can copy that across. And we have, if we look back at our line of credit balance, we have an ending balance there, ending amount. Just want to make sure I got this formula right, F22, which was our ending amount here. All right, so we've now done step 8, the balance sheet for our debt levels. We've got another tricky statement, formula to put in now. But before we do that, let's complete the financing, part of the financing section on our cash flow statement. So we can put in our new borrowing from the debt schedule, which was 100 in that year, and we copy that over. And let's look at the repayments, which also come from the debt schedule. Oops. Equal to that, and these should come in as negative amounts. Okay. Now we're going to handle that line of credit formula that I mentioned before. Basically, what this does for the model is says if there's not enough cash to go around, we need to either, some models would have you go into a negative cash situation. I don't think most bankers like that. They like to show it as borrowing on a line of credit. So we're going to have a few nested if statements here. We're going to say if both, so and, our prior year's line of credit balance is greater than 0, and our cash available for debt payments, less, let's not forget that we had a minimum cash balance to lock in, if both of those items are true, basically we have a previous balance, which I need to add a comma to, and that, then we want the minimum of that balance sheet previous balance and the sum of our cash available less our minimum cash balance, which we need to lock. If both of those aren't true, the alternative assumption was to use the minimum of 0 and, you can see these a lot, cash available minus our assumed minimum cash balance. Oops. Cash available minus our assumed cash balance. And we'll copy that across. After copying that formula across, there's just a few more items we have to do. We have to show that use of cash on the debt schedule. So we link that line of credit sweep to the formula that we just put on the cash flow statement. We can also, now that we have an ending cash on the cash flow statement, link that to the top of the balance sheet. and copy that across. We can now finish our income statement by copying across the formula in there, which basically just averages out the balance sheet cash times our assumed cash interest rate. We can now do our tax assumption, basically take our pre-taxes times our assumed tax rate, which we'll lock. Income statement is done, and balance sheet is balanced with our zeros across the bottom. Now I just want to show you that line of credit in action since it's not kicking in here. But let's assume our company had a terrible year in year 2. Cost of goods, instead of being 50%, we're 90%. You can see we've got negative EBITDA, negative net income. So with us not wanting our balance sheet to go into a negative cash situation, you can see our balance sheet goes down to its minimum cash, which was one of our assumptions. And you're going to see a line of credit borrowing to balance everything out. Let's see that it comes in on the cash flow statement as a borrowing, and then it's repaid promptly the next year. So our balance sheet reads across 0 line of credit, yes line of credit, and then 0 line of credit again. Let's just undo what we did to get the model back to normal. But we have just created a basic financial model with income statement, balance sheet that's balanced, cash flow statement, and a debt schedule. Let's just play around with a few other things. Instead of a 5-year amortization, let's just show you that the debt really does get paid off. Let's make it 2 years. And you can see on our debt schedule, we borrow 100 million, pay off 50 and 50. I want to show you that that formula doesn't allow for us to overpay. If we pay it off over 1.5 years, it gets paid 2/3, 1/3. If we pay it off in 1 year, you can see we've took in 100, paid off 100, but that formula that we created here with these nested ifs makes sure that we don't over repay our loan. Move that back to 5 years. Congratulations on finishing a financial model. We'll do some advanced topics in future modules.